Every single day, over 1 billion credit card transactions take place globally. Just think about that sheer volume for a second. Welcome to this explainer. Today we're going to peel back the onion on the massive, incredibly complex architecture that powers modern digital payments. When you look at the smooth, polished surface of your favorite payment app, or you hold one of those heavy metal cards in your hand, it all looks remarkably simple. But beneath that sleek surface is a total labyrinth of operations, regulations, and technologies working together at absolute lightning speed. We're going to explore exactly how this hidden ecosystem operates under the hood.
Here is our roadmap for mapping this out today. 1. The invisible swipe. 2. The two-body myth. 3. The unsung hero. 4. The 5-layer stack. And 5. The embedded finance revolution. Let's get right into it.
Section 1. The invisible swipe. Let's start with a totally familiar surface-level action, like paying for your morning coffee or hailing a ride with cards from Starbucks, Uber, or Chime. You tap your phone or insert your chip, you wait maybe 2 seconds, and boom, you get a green checkmark. We absolutely take this for granted, but I want you to really think about the operational miracle that has to occur behind the scenes to approve that transaction instantly. Think about the stark contrast between our impatience as a customer waiting for that little beep and the incredible technological sprint happening globally in that exact same window of time.
In those brief 3 seconds, a massive digital pipeline is firing on all cylinders. Imagine this. The exact moment you tap, data leaves the coffee shop's terminal, hits an acquiring bank, travels across the massive Visa or MasterCard network, reaches your specific issuing bank to verify your identity and check for sufficient funds, and then races all the way back to the coffee shop. All of that happens without missing a single beat. It's wild. Today's explainer will show you exactly how that digital pipeline works and who is actually responsible for keeping it from breaking down.
Moving on to Section 2, the two-body myth.
Most people think launching a card program is just a simple deal between a slick fintech app and a traditional sponsor bank holding the money. But that is a complete myth. There's immense cultural and regulatory friction here. It's basically like trying to connect a chaotic neon-lit tech office running on Red Bull directly to a 100-year-old marble bank vault moving at a snail's pace. It doesn't work. Tech companies want rapid user growth. They want to move fast, break things, and design beautiful, frictionless user interfaces. Meanwhile, traditional sponsor banks operated that snail's pace for a very good reason. They are extremely risk-averse, highly regulated, and strictly focused on compliance oversight. A single mistake for a bank costs millions in regulatory fines. They literally speak completely different operational languages.
Imagine a fast-moving gig economy app trying to give instant payout cards to its drivers. If that tech company tries to talk directly to a traditional sponsor bank, the system basically crashes. The tech company gets instantly buried. Take BIN regulations, for example. BIN stands for Bank Identification Number, which is the first 6 digits on the front of a card that identifies the specific bank. A tech startup has absolutely no idea how to legally manage and report on these numbers, so they hit massive compliance gridlock. What was supposed to be a fast, agile product launch turns into a multi-year delay, all because the fintech doesn't know how to speak bank compliance, and the bank has no idea how to speak agile software development.
Which brings us to Section 3. Meet the program manager.
Because of this massive gap we just talked about, the entire system would freeze up without a critical intervention. A third player has to step in. Enter the program manager. They are the unsung hero operating behind the scenes to act as the operational translation layer and the glue between the fintech and the sponsor bank. Think of them like a universal translator in a sci-fi movie. They take the rapid, agile API code coming from the fintech and translate it perfectly into the rigid, highly regulated compliance language required by the bank. The program manager absorbs all the back-end complexity so that these two completely different worlds can actually function and successfully launch a card.
This breakdown clearly shows the strict division of labor. On the left, the fintech gets to obsess over owning the customer. They control the product design, they make the mobile app look absolutely gorgeous, and they handle all the marketing. On the right, the sponsor bank gets to sit back and act as the regulatory vault. They provide the regulatory foundation, hold the BIN sponsorship, secure the network membership, and provide the ultimate compliance oversight. And right there in the middle is the program manager, acting as the operational bridge connecting them, handling the rigorous day-to-day management that makes the card actually work in the real world.
So what does that day-to-day management actually look like? Well, to survive, the program manager runs a highly demanding operational gauntlet across 3 main pillars. First, network requirements. They're the ones navigating the massive, complex rulebooks of giants like Visa and MasterCard, so the fintech doesn't have to. Second, compliance support.
They're setting up stringent KYC, which is Know Your Customer, verifying the user isn't a fake identity, and AML, anti-money laundering, ensuring the money isn't tied to illegal activities. These systems have to perfectly satisfy the bank's strict auditors. And finally, ledger management and settlement. This one is absolutely crucial. Every single time you buy a $5 coffee, the Fintech's sleek app updates instantly, but the bank's official legacy ledger takes time. The program manager has to reconcile these two completely different databases at the end of the day, down to the exact penny, so no money simply vanishes into thin air.
Section 4. The 5-layer stack.
Launching a card program requires intense coordination, and this is the complete technical stack required to make it happen. Let's construct this infrastructure layer by layer. We start at layer 1, the Fintech. This is the customer-facing front end, the beautiful app on your phone. Data flows from there down to layer 2, the program manager, which scrubs, translates, and handles all those daily operations and ledger data we just talked about. That seamlessly feeds into layer 3, the sponsor bank, providing the regulatory green light, holding the funds, and providing the BIN. But here is the really interesting part. Legacy bank computers often can't process transactions fast enough, which brings us to layer 4, the issuer processor. These are highly technical, specialized engines, like Marqeta or Galileo, that act as authorization routers, physically processing the ones and zeros at lightning speed because the bank outsources this to them. And finally, layer 5, the payment network, Visa, MasterCard. They act as the massive global superhighway connecting the merchant's bank to the issuer's bank. This full 5-layer stack is the true architecture of every single modern card swipe.
And that brings us to our final part, Section 5. The embedded finance revolution.
Zooming out, understanding this complex 5-layer architecture is absolutely critical right now because of a massive structural shift happening in the global economy. We're moving rapidly away from the era of dedicated standalone fintech apps and headfirst into the era of embedded finance. We are entering a macro landscape where every brand, regardless of what they actually sell, wants a piece of the financial pie, which is driving an unprecedented demand for these unseen operational layers.
Today, non-financial companies want to become financial players. Giant retailers, massive SaaS platforms, logistics firms, and gig economy apps all want to issue their own branded cards. Take a logistics firm, for example. Say they want to pay their thousands of cross-country truckers instantly via a branded company card. Why do they want to do this? To lock in customer loyalty and, more importantly, to capture lucrative interchange revenue. Interchange is that tiny 1% to 2% fee that gets swiped from the merchant on every single transaction, and it adds up fast. But here is the catch. None of these companies are banks. Because they aren't banks, they cannot launch these card programs alone. Consequently, the demand for program managers, that vital operational glue, is absolutely skyrocketing across entirely new industries.
The end consumer is completely blind to this back-end architecture. But the next time you seamlessly swipe your favorite brand's card, think about the invisible operational gauntlet making it possible. The tech, the bank, and the unsung hero absorbing all the friction in the middle. As every company races to become a fintech, it leaves us with one incredibly vital question. Does your company have the architecture to compete in the embedded finance revolution?